Chapter 15, we talk about audit sampling for tests of controls and then substantive tests of transactions. So sampling is one of the ways that the auditors test, just generally speaking. So there's different types of sampling. So a representative sample is that characteristics of the sample are the same as the characteristics of the population. So that's going to be our assumption if we're going to do a representative sample, is that anything that we pull out is going to basically represent the population as a whole. Then we have two factors of non-representative samples. So non-sampling risk that's the risk that the auditors will fail to recognize an exception or an ineffective audit procedures. So the proper design of the audit and proper supervision will help eliminate that non-sampling risk. And then the sampling risk is that the auditor is going to reach an incorrect conclusion about the population based on the sample that he pulls. So again, we're assuming that it's a representative sample, and then so we're making some assumptions about the whole population based on the few that we've pulled and we've sampled. And so there's always a risk that what we pull really doesn't represent the entire population. And I guess so to go back to that non-sampling risk, that again we're gonna because we don't sample 100%. So you only are going to sample, say, maybe 10% of the transactions. So then what about that other 90%? There's always a risk that we're going to fail to recognize something, by the fact that we're not testing in all those areas. So the types of sampling that we can do, or that auditors can do, is statistical sampling. So that's using more mathematical rules, that maybe have certain dollar amount criterias, or that have vendors that have more transactions, or customers that have higher accounts receivable balances. So there can be different mathematical things that we can apply in to the sampling, so that we're testing some of those more significant areas. Then there's non-statistical sampling, where the auditor is just going to use their judgment to pick those most significant items. So again, to say the highest dollar invoices that were issued, we're going to look at the top 10 highest dollar invoices. We're going to look at the top 10 highest vendors that were paid, or just something along those lines, where they're going to say, we're going to look at these significant items, and we're not going to just randomly kind of go through and pull different samples. So the similarities is that you're going to plan the sample, you're going to select your sample, and you're going to test the data, and then you'll evaluate your results, and then you're going to make some sort of conclusion about the population as a whole. So probabilistic sample is just using a strictly random sample. So every single item in that population has an equal chance of getting pulled. So they can do that through the use of computer systems to come up with just a complete random sample. And then there's a non-probabilistic sample, where the auditor uses their judgment, again, to pick those most significant items. So like I said, all of the like in the pool, it's going to be all of the invoices that are over $10,000. So you're going to then randomly select within that group. So you're picking out the more material transactions and then pulling a sample from those. So again, the different methods. So we've got that simple random sample selection, where every item has an equal chance of being selected. Then there's a systematic sample selection. So it selects items at intervals. So like every 1,000th transaction, maybe you're going to pick and pull. Then probability proportional to size. So that's what I said, like you're going to pick all of the sales transactions that are over $10,000, and then you're going to run a random sample of those. So those are, again, probabilistic sample selection methods. Then the non-probabilistic sample selection methods are like a block sample selection. So then you're going to select a block of transactions, and those would be, again, several items that are in like a sequence. Then there can be haphazard sample selection, where there's no regard to criteria. You're just gonna, kind of like pulling numbers out of a hat kind of thing. But what they say is you would use those if the transactions aren't numbered sequentially. So maybe they're numbered in a different way than pre-numbered, going 1, 2, 3, right in order. Then you can use that haphazard sample selection. So exception rates, an attribute is a characteristic that is of interest to the auditor. The exception rate is an item that contains the attribute to the total items. So like if, you would deal with deviations from that expected result. So your exception rate is going to be like your sampling error, and it's going to become an estimate for that entire population that you poll. You could do a computed upper exception rate, where it's the sampling exception rate plus a sampling error. So let me see if I got any. So again, like when it talks about in the textbook, some of the following types of exceptions that the auditors are going to be interested in is deviation from the client's established controls. If there were monetary misstatements in the population of the transaction data, and then monetary misstatement in the population of the account balance details. Because again, they look at transactions, and then they look at what is the balance at the end of the year, and is there any deviations in those. And then again, the deviation is a departure from the prescribed controls. So again, if we said we're following this particular process, and then we don't. And again, deviation rate is often used instead of exception rate when we're referring to our test of controls. So the deviation rate deals more with the test of controls. Okay. Then we get into, and there's a table in your book that shows kind of these terms used in the auditing sample. So we've got the ARO, which is the acceptable risk of over-reliance. So that's basically the risk that the auditor is willing to take of accepting that a control is effective, or that the rate of a monetary misstatement is tolerable when the true population rate is greater than the tolerable exception rate. Then there's the TER, the tolerable exception rate. So that is the exception rate that the auditor will permit in the population and still be willing to conclude that the control is operating effectively, and or that the amount of the monetary misstatement in the transaction established during planning is acceptable. Then we have the estimated population exception rate. And that's the exception rate that the auditor expects to find in the population before the testing begins. And then the sample exception rate is the number of exceptions in the sample divided by the sample size. And then that computed upper exception rate is the highest estimated exception rate in the population at a given ARO, or acceptable risk of over-reliance. So again, those are probably ones to just kind of understand the definition, and then understand the abbreviations of those if you have them, like, in any of your homework or your questions, just knowing what they mean. All right, then we have the application of our audit sampling. So basically, you've got to state the objectives of the audit test. If we're testing the operating effectiveness of the internal controls, or if we're testing the transactions to ensure that they're free from material misstatement, decide whether the audit sampling applies, and if we're gonna sample, if our sampling is appropriate for documentary evidence, define the attributes and the exception conditions. So that's kind of some of the stuff that we were just talking about. Define the population, define the sampling unit, specify that the tolerable exception rate, what is that highest exception for the auditor to still assume that the internal controls are actually working. Assess the ARO, which again is the acceptable risk of over-reliance. So public companies that do extensive internal control testings will have lower levels of risk that they're willing to assume, so they're going to have a higher sample size. Then we're going to determine the estimated population exception rate, and if it's small, then the sample size is small, and then we'll determine the initial sample size. Then we'll actually select the sample, we'll perform our audit procedures on that sample, and then we'll make a generalization from the sample to the population. So again, there's some mathematical computations that go into that, and then we'll analyze any of the exceptions that we find. So the factors that indicate what type of sample size we should take is the overall population size. But again, in today's world, sometimes that can be very large. There's all kinds of data to choose from. The tolerable exception rate. So there's an inverse relationship there. If our tolerable exception rate is increased, then our sample size is decreased, because it means we're willing to accept a little more error so we don't have to sample as much. If our tolerable exception rate goes down, then we're going to want to sample more. We'll want to get more comfortable by actually looking at those real results. The acceptable risk of assessing the control risk too low. So if we increase that, we're not as worried about it. We can decrease our sample size. If we decrease that and we are very worried about it, we're going to have to increase our sample size. And then if our estimated population acceptance rate, if our estimated population exception rate goes up, then our sample size is going to go up, because we're saying we estimate that there's going to be some errors in there. So we want to test more to get more comfortable with that data. And then we decide the acceptability of the population. So if we have our TER, which is our tolerable exception rate, minus our SER, which is our sample exception rate, if that number is too small, we'll want to expand our sample size, or we'll want to revise the risk levels to say maybe there is more risk involved with this and communicate that to the management. And then obviously the auditors document all of this process. And a statistical sample is going to go through all these same 14 steps, but just in a more quantitative rather than qualitative type of a way. And they give us, do they give us this in the text? Follow the tables in the text. Let's see if I can get to okay, yeah, so the non-statistical sampling tests of control we've got on the table 15.4 and 15.5 gives you some guidelines on those. Those are non-statistical though. Let's see. Then they give you some examples. They're like 15.4 gives you some examples of some of the tests. oh, here. Then on 15.8 is the like where it's actual tables where you can identify how big should I make the sample. So it's like different tables that show you, and it's based on your exception rate compared to your tolerable exception rate, so that um, population exception rate compared to that tolerable exception rate, and then you can kind of, you know, take those and trace those through these tables to figure out how large to make it. So again, it's a little bit more mathematical. Okay. So look through those though, because the textbook gives you a lot of large figures that I couldn't put into the PowerPoint. They just were too big. Just showing you some of these examples.